All right, thanks everyone for joining us today. Really appreciate you taking time out of your busy schedules. Today's topic is making moves in 2021, especially for those of you that are in the kind of real estate investment uh, concept and strategy. And so we did this certainly at the beginning of the year. A lot of people are talking about goal setting, and we thought that it'd be helpful really about kind of halfway through the year to do kind of a refresher and talk about some ideas about how to kind of navigate what is certainly a very hot real estate market in almost every part of the country. And so hopefully there'll be some value in there for you today as you're kind of thinking through perhaps you're just launching your real estate investing career or you just kind of feel stuck. And so you're just trying to find a little bit of traction in this, again, very, very hot real estate market. Excuse me. So my name is Sean McKay, and this is technically an American IRA presentation. Our service is self-directed retirement accounts. Now, certainly we're not really going to focus on the self-directed concept itself. Hopefully, this will just be kind of a value add for those investors that are kind of thinking about how to structure different types of portfolios. As is always the case, though, you want to make sure that you're leaning heavily on your professionals. So your tax advisors, your legal advisors to give you the appropriate structures around doing any sort of investments. Excuse me. So at American IRA, we are not financial advisors. This is really just for conversation purposes around different investment ideas. Now, for those of you that are interested in the self-directed arena, really for us, there's kind of two tangible ways that we believe we really stick out from the competition. And so first and foremost are the fees. So our fees are incredibly cost effective for our clients. As you can see from this chart, you're typically going to be charged an annual fee either based on the size of the account, which means as your account balance grows, so does your annual fee, or you're charged an annual fee based on the number of assets that self-directed provider is administering. Our model is different. So whether you have $1 million, whether you have 100 assets, our baseline annual fee for our IRAs is $285 a year. So as you can see from the comparisons, that is incredibly cost effective. Now, of course, low fees are great, but you want to make sure you're getting value for the fees that you are actually paying. And so again, from just this isn't an opinion thing where, hey, I think our operations team is phenomenal and better than the others. You can really just simply go online and look at reviews. So depending upon the platform that you choose to kind of be your go-to for reviews, whether it's Google reviews, BBB, etc., very highly rated. So we're very proud of that. Again, we do believe that's largely due to our operations team. They do a phenomenal job servicing these accounts. But please check us out as far as the self-directed concepts go. But again, today we're really going to focus on kind of the real estate investment journey and perhaps how to think about our goals and what we're trying to accomplish in today's investment world. So the first idea is just getting laser focused. I think so many of the investors that I meet that are just getting started are really kind of all over the place, and they're not really aligning their goals with what their core strengths and abilities are. And so I'm going to preface a lot of what I'm talking about today by just simply stating this. I don't pretend to be a special real estate investor. I've had the fortune of being in the real estate investment game since 2002. And also just simply with this job at American IRA, I get to learn and grow by simply being around so many phenomenal, intelligent, successful real estate investor clients, real estate entrepreneurs. And so that has been really, really beneficial for me. So I'm really just simply trying to pass along, quite frankly, the information that I've been very fortunate to receive from those individuals. So anything I say today that has any value whatsoever, quite honestly, is me trying to just simply regurgitate information that I've gotten from those much more intelligent individuals. So with that as the backdrop, hopefully you understand I'm not putting myself on a pedestal here, just trying to add something to the conversation. So ultimately, when I think about real estate investing, I think about it largely in terms of there's the transactional side and then there's the long-term wealth building side. So for me, the wealth building side is when, as investors, we're thinking about holding assets. So largely that comes down to holding rental properties. So it could be single family, could be smaller multifamily, it could be larger commercial, whatever is sensible to you and what your goals are. That's a great wealth building strategy for the long term. On the transactional side, to me, that's essentially everything else. So whether you're a wholesaler, you're flipping houses, you're doing spec homes, that is a way certainly to do very well and create significant chunks of capital. It's just a different game. And it's not to say that there aren't a lot of investors that play both games, but I think what can be a little bit dangerous is if you're trying to learn and do all of those things simultaneously, that can be a really big undertaking. And so I think a really helpful exercise is thinking about your real estate investing in terms of like two general categories. And so that being the amount of capital that you have to invest and the amount of time that you have to devote to this real estate endeavor. I submit to you that if you are lacking in time, then being transactional can be very, very difficult. So being a wholesaler, if you have a 60, 70-hour a week day job, is going to be very difficult. Wholesaling is obviously, you're going to need volume of activities to be able to create those chunks of capital. And so that's really a way of thinking about this. So when I hear, I'm working a massive amount of hours and I want to flip houses, my experience would say that has a lower likelihood of being successful long term than somebody who's working a tremendous amount of hours. Hopefully, they have some savings capacity, and so maybe the journey to financial freedom or whatever your ultimate goal is in accumulating good long term assets. So maybe you're buying one or a few rental properties a year. And over the long haul, you're going to have these paid off properties. It's a great income stream. And maybe that allows you to replace income in your day job. So I'm certainly not trying to push anyone towards a specific strategy, but really just try and align what your goals are with what your skill set is. Now, also, really a kind of a common theme today that we're going to talk about is trying to be really specific with your strategy. And so the first thing I want to mention with this is there's an example of a very, very successful real estate entrepreneur in the Stanford area in California. So around the Stanford campus, obviously that's, kind of the Silicon Valley-esque type area. And so there's an investor, John Arriaga. I actually heard about this investor listening to a really successful equities investor in Monish Pabrai. So Monish Pabrai talks about John Arriaga as an example of it doesn't matter what you know, it's important to just simply stay in the meat of your kind of sphere of competence, if you will. So John Arriaga has literally become a real estate billionaire by investing, I believe it's within 2 miles of the Stanford campus. He's done a tremendous amount of commercial projects there, and he's been a long-term entrepreneur. He's held those projects sometimes for decades and decades. And so he has a very, very specific niche because he had clarity in terms of where he was going with his real estate business. And so I think that's helpful. You don't necessarily need to be investing in multiple markets, just really understand the market and the strategy in that market that you're trying to execute. So the next idea is kind of an add-on to that, and that's the idea of being the go-to for a specific strategy. So we're getting clarity, we're kind of narrowing our focus. So we're going to just be, really cranking out wholesale deals, or we're going to buy small multifamily buildings, or whatever the case may be. We're getting as much clarity and we're whittling down to get as precise as possible with exactly what we're trying to accomplish. And so when we have that, it's really critical that we are sharing our story, whether it's inside the investment community, but also outside the investment community. You never know what friends, family members, people you just meet around town, sooner or later you're going to get turned on to some deal just by simply sharing your story. And so, to me, a way that I think about this is this was advice certainly that was given to me. And so I decided to kind of maybe perhaps take it to a little bit of an extreme. But when I would talk to people about the types of real estate deals I was looking for, I was incredibly granular with exactly what I was looking for. And so I call this the three little pigs story. Basically, in a nutshell, I would go to these real estate meetings, and you find a lot of times people are saying, like, I'm looking for a deal or I'm looking for a flip. And so it's a little difficult for someone to think of them when they come across an investment because it's so broad in nature. And so I was kind of the other end of the spectrum where I would say, I am looking for a side by side duplex that is in X part of town. And I want these to be brick buildings built in the 1950s or 60s, side by side, on a crawl space, just very, 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 very specific in terms of what I was looking for. And so that was super helpful because, for one, people thought I was, there was almost something wrong with me because it was, again, so granular. But I would get calls from investors in town. Hey, I got this wholesale deal that I'm going to sell to somebody. I know that this is a pocket, this is a type of property that you like and you're investing in. So I figured I'd give you a call first and see what you think. So the more granular you can get, you might think that you're going to miss out on opportunities because your niche is so small. I would argue that if you're just kind of taking a look at any and all opportunities that are out there, it's easier to make mistakes because you're not focused on exactly what you're looking for and what you want. So just a little bit of food for thought there with the three little pig stories. So lesson number 3 is, I call this seller participation, but it's basically getting the seller of the property to be involved in financing at least some part of the investment that you're purchasing from them. And so many times this has to be done on off-market real estate deals. But basically, in a nutshell, you are involving the seller so that maybe you, or in some cases your retirement account with a self-directed account, are putting whatever is the negotiated down payment with that seller so that they're willing to finance the remaining portion of that deal. And there's so many benefits associated with structuring seller financing deals. For one, you're able to cultivate like a true win-win for both you and the seller. Because if your seller happens to be another investor, he might have some very specific outcomes that are going to be most beneficial. Sometimes those old landlords don't want to get just simply cashed out at closing because they have a more significant tax bill. So if they spread out the money over a series of many years, sometimes decades, then that actually helps them to keep more of their money. It also helps them to do something with this base of capital, this equity that they have in the deal, because they're in a scenario where they're going to take that money. Many times, if you're a real estate guy, it's not always common for you to be terribly enthusiastic about the stock market world. And so a lot of times these landlords, they'll just simply put the money in the bank. They're making, in this world, essentially nothing on CDs and money markets. And so it's almost impossible for them to get a decent yield. But if they seller finance that to you, and again, if you're able to even negotiate a 3, 4, 5% interest rate with that seller, that's much more beneficial for them than getting far less than 1% on their money. So again, this can be a huge win-win. Now also, every state is very different in terms of rules, regulations, laws. But in North Carolina, what I will tell you, and obviously you want to verify this with your legal professionals, is that North Carolina typically, at least on the residential end, on the seller financing real estate transactions, is by default a non-recourse debt structure that you're setting up with that seller. And so in that scenario, you are actually creating a scenario where your retirement account can purchase a property with seller financing and be compliant from the retirement account's angle, because as I'm sure many of you are aware, an IRA or 401k must get a non-recourse loan if it's going to use financing. So a lot of benefits associated with seller financing deals. So if you're able to get face-to-face with sellers, there's a lot of positive situations that can come from that. Now, lesson number 4 is especially pertinent in my mind in this really hot real estate market. It's so tough to get a quote unquote deal in this smoking hot real estate market. And so we're going to probably want to create more relationships with wholesalers in town. So these are individuals that are directly marketing to owners of properties, and they're able to, from time to time, get quality deals. And so if you get a relationship with a wholesaler where you become one of their go-to buyers, to me, there's 2 very critical rules that we want to follow to have a great win-win relationship with that wholesaler. And the first is just simply don't count their money. I cringe when I think about investors that think wholesalers should only make X profit for a real estate deal. I think that is absolutely the wrong way to look at it. We don't go into a store and say, well, the manufacturer or the retailer for this shirt, for example, is only into this shirt for $10. There's no way I should have to pay whatever it may be, $40 for the shirt. That's too much of a spread. No, they have overhead, they have marketing costs, they have employees. We just simply need to look at that shirt and say, and I think we inherently do, and say, do I like this shirt enough to pay $40 for it? So to me, the same thing is true with real estate. When the wholesaler presents the deal, you simply look at the deal and say, is this number that I have the opportunity to buy this property for a deal that I like, that makes sense for my criteria? We don't need to worry about how much the wholesaler is getting to mark it up. If it's a deal, it's a deal. Don't count their money. So I think I was pretty thorough with that part. Rule number 2, so basic, but it is shockingly not always followed, is just simply do what you say you're going to do. There are so many buyers today that are posturing, I can do this, that, I can close in a couple of days, I got cash in the bank, yada, yada, yada. When push comes to shove, they don't make it happen. They don't have the cash, they don't have the relationships to close it in a few days. So you're wasting people's time. You're wasting that wholesaler's time. You're wasting the seller's time. And so you really want to be respectful and, again, just do what you say you're going to do. And so the example of that was, I call this the East Charlotte package. So there was a wholesaler that ended up reaching out to me, actually had quite a good deal. This was in 2020. So this was last year if you're listening to this live or anytime in the near future. And so again, very, very hot real estate market. Charlotte is, depending upon the resource that you get, it's usually about a top 5 metropolitan market in terms of the percentage of appreciation we have. So a lot of eyeballs, a lot of people interested in investing. And so the wholesaler reached out to me. I owned some other properties in that neighborhood. And he said, hey, just want to touch base with you, see if you're interested in this package. We talked through the deal. Yes, I'm interested. That works. Again, it's a, seller's or a wholesaler's market, if you will. And so he wanted to make sure that I wasn't going to waste his time. And he wanted to make sure that I really could close, because he had a very short fuse on this deal. And that was his concern, was he couldn't have me wrapping up this property and then, frankly, even taking 30 days to close the transaction. There just wasn't that much time for him. He had already been burned by other people that weren't able to carry the deal out. So his time frame to close was very short. So frankly, because I had been a closer, again, I'm not a special person, but if I say I'm going to do a real estate deal, I do it. I just simply said to him, hey, listen, you're a wholesaler in town. We're all connected in today's world with social media and relationships and all this kind of stuff. Why don't you go and talk to, and I named out a couple of other very prominent wholesalers in town. And I said, I've done deals with these individuals. Why don't you just talk to them and let's just kind of reconvene in a day and see if you feel comfortable moving forward with me. And because I do what I say I'm going to do, reached out to a couple people within, frankly, a few hours. Again, he had a short fuse, got back in touch with me and said, okay, it sounds like you're not going to be another time waster. Let's do the deal. And so it ended up being a quality win-win. He made a tremendous amount of money between the 3 units. He actually took home $50K in terms of wholesale assignment fees, but I was okay with that. I was buying them at a discount. They were going to cash flow. I was going to put money into them, and I certainly did. But still, the net numbers, when it was all said and done, worked for all parties. So just something to think about with the wholesalers. Now, part number 5 is an idea. It's just an idea. It doesn't work certainly for a lot of people. The idea of being a contrarian. Obviously, if we're all contrarians, we're not contrarians. So there's only a finite amount of people that are going to feel comfortable living in a way where they're going to go against kind of the popular sentiment and go against the grain. And so, I think it's very comfortable as human beings. We want to be a part of tribes. We want to be a part of what seems like the kind of the status quo of what's going on. And that's completely understandable. When it comes to investing, being a contrarian usually is going to give you a pretty drastic outcome. You're either going to be really right, and you're going to be someone who can make above average returns because you're going in a different direction than the typical money flows, or you can be dramatically wrong. You can miss sometimes either obvious elements or some nuance, and you can make some pretty drastic mistakes. So this certainly is not for everybody, but it's something where if you can think in terms of, in the real estate market, okay, everyone's going after a certain type of property, or they're going after a certain type of area. That is obviously going to be where the most competition is. That's where the prices are going to be driven up the most. And so you're probably going to get less value in kind of, especially being late to the game, where you're following where everybody's going with their deal structure. So just an idea to consider would be, if people are going to the west side of town, maybe you consider going to the east side of town, or vice versa, just simply, again, from the competition standpoint. Now, obviously, you want to feel like the east side of town in that example provides the types of opportunities that you think will be beneficial for you. But if you think that that's fertile hunting ground, then that could really be something to think about. So it's always something where you obviously need to check your facts. You need to seek counsel from other people and say, all right, everyone else is going west, I'm going east. Tell me the downside of east. And if it's just something as simple as, well, it just doesn't seem like there's going to be as much upside. It's not as sexy. It's not as whatever. But you're looking at the product out there and you're saying, well, I can buy a little bit cheaper. The rents, frankly, are just about as good as on the west side of town. And I'm able to buy properties with less competition. Well, maybe the appreciation won't be quite as great over the next 5 or 10 years. But if you're playing the cash flow game where you're trying to stack your single family rentals and you want to get to 10 or 30 of them or whatever your number is, that's fine. You're playing your game. You don't have to play other people's games. A quick example of that, I call this the hedge fund story, is that as many metropolitan areas experienced, starting in about 2011, 2012, hedge funds started coming in heavy into metropolitan areas, and overnight prices skyrocketed, just supply and demand. And so what we found was the properties that we were buying at that time, we got priced out of the market completely within months. We could not find a deal. The hedge funds were buying everything. The price points didn't make sense to continue to buy. And frankly, I wasn't creative enough to figure out how to pivot. I was very lucky. I got some guidance from other investors in town. And ultimately, the suggestions that I got was simply pivot your portfolio. You're buying newer properties that are more kind of out in the suburbs. Why don't you stop trying to fight the 10,000-pound gorilla, the hedge funds? You're never going to be able to compete with them or their money, their resources, and frankly, they don't have the same need to buy at a discount that you do. They just need to accumulate a volume of properties. Why don't you go maybe more in town and older properties? So that's what we did. We actually sold to the hedge fund our properties over the next couple of years, and we would do 1031 exchanges into older properties, some single family. We got more into the smaller multifamily space, and it worked for them and it worked for us. So it doesn't have to be a winner and a loser. It just meant that everyone got to kind of continue on their investment journey. So we kind of went against the grain. All the big money was going newer products, so we started going older products. So just something to think about there. So that's kind of today. That was just a couple of thoughts on how to think about your investing in this kind of very dynamic market that we're all in. Our next webinar is going to be on June 23rd if you're listening to this live, so that'll be at noon. If you're unable to actually attend that live, definitely feel free to register and we'll have the recording and we can send that to you after the presentation. So that'll be on investing in tax liens and tax deeds. So hopefully that's of interest to some of you. If you're looking for more content, we do have a YouTube channel. You could check us out at American IRA LLC. So if you search American IRA LLC, you'll find our channel, and we'll be able to you'll be able to download any number of videos on there. Excuse me. Working through some allergies right now. So for any of you that are listening live, definitely feel free to type into the questions box now. We can dig into any thoughts or questions you have. So again, I'm Sean McKay with American IRA. My email is Sean, S-E-A-N, at AmericanIRA.com. Our website is AmericanIRA.com. And our phone number is 828-257-4949 if you're interested in self-directed accounts. All right, so we'll open this up, see if we have any questions here. All right, so got a couple questions here. So the first one is, can I invest in Section 8 properties with your self-directed accounts? So the short answer is yes. Any kind of rental type of strategy where really the Section 8 just revolves around the types of residents that you'll have, that is something where you can certainly do those types of investments with your self-directed accounts. So Section 8 rental properties, that is a yes for IRAs and 401ks. All right, so next question is, can a husband and wife use their own self-directed IRAs to purchase a single real estate property? So yes, we do see scenarios where as long as it's at the time of acquisition, we do have clients who will actually partner spousal accounts, family and friends, whatever it may be, to do a particular real estate deal. All right, so next one's kind of more of a macro question. How does the Biden's proposed tax law changes affect our IRA accounts? So it's a good question. There's certainly a lot of layers to the tax proposals. So, just a couple of things that have been thrown out there. Certainly, there's a lot of talk around increased tax rates. And so with that, I think certainly we can, excuse me, we can all agree that being in tax efficient vehicles such as retirement accounts will be even more important to our investing. Because if we think about it this way, if we make investments personally and we have to start paying more and more in taxes for money that we make, that makes those personal investments less desirable. Conversely, when our IRA or 401k makes investments, the vast majority of the time there is not going to be a tax consequence when your retirement account makes an investment. And so with that, we're able to be very tax efficient if we sell an asset or, whatever the case may be, cash flow from the asset. So the more the tax rate goes up, the more our retirement accounts are going to be so critical to our wealth building. Another part that's been discussed is the idea of getting rid of 1031 tax exchanges. that is not a service that we provide. But again, if 1031s go away, then really the only opportunity that we have to be tax efficient is for our retirement accounts to own assets versus our personal names, LLCs, et cetera. So really a lot of this does come down to, as there's going to be some inevitable ratcheting up of tax rates and what have you. This is a non-political discussion, quite frankly. It doesn't matter which side of the aisle you're on. We just know that tax rates are going to be increasing, and thus retirement accounts are going to be so critical to our overall wealth building. So, any other thoughts or questions? I'm happy to dig into that. All right, great. Looks like that's all we have today. Again, really appreciate everyone's time, and hopefully we'll see you checking out our YouTube channel as well, American IRA LLC. All right, thanks so much, everyone. Have a great day.